On investing for your goals. My name is Sarah Antofer with Focused Financial Strategies, and this is a continuation of our three-part series on financial planning. In part one, we talked all about how we prioritize goals, naming concerns, identifying the type of goals we want to consider, whether they're short-term, long-term, or intermediate, how we plan for emergencies, the importance of budgeting for our financial priorities, and managing credit. So those are part one. And I said in our part two, we'd be going into a little bit more detail on how we select the right investments or investment products for us to begin to invest in. So it's, first of all, you can't start with your part two with, investing in a specific place until you already have a good budget in place, you've got an emergency fund in place and it's up and working. Once those things are going, now we can start into part two. We're going to talk today about qualified and non-qualified investments. We're going to talk about understanding risks and risk management strategies. That's going to be the backbone of our conversation around how do we choose the right investment option for our goal, for our objective. Let's jump in and start with that. Before you can get into picking an investment, it's really, really important that you take the time to understand the tax structure of the investment that you're considering investing in, because it is the tax structure of the investment itself that may make one investment option more suitable for you than another investment option based on your goal. So when we think about our investments, we generally are going to have qualified and non-qualified investments. A qualified investment has tax-deferred growth. It's going to be income, you're going to pay income tax at the point of distribution. It's going to depend a little bit on the vehicle, but a qualified account is going to tax defer growth, and it's going to have some kind of income tax options available for us when we take the distribution. A non-qualified, every year, we are going to have to recognize capital gains or losses. There are some tax-advantaged options that exist inside a non-qualified investment. We'll talk a little bit about that. But the primary reason when people talk about a qualified investment option versus a non-qualified, what they're really talking here about is what kind of tax-deferred growth you're able to get on that. Do you have to file taxes on those every year? Do you have to include those every year with your taxes or not? Limits. So because the IRS is giving us tax-deferred growth on a qualified account, they are going to make sure that those are subject to annual contribution limits. That's going to be indexed annually by the IRS. Different products for a qualified investment will have different limits. So for example, an IRA has different limits than a 401k. We'll talk a little bit about that, but the limits are different. Non-qualified, they don't have limits, right? Because you're going to be recognizing gains and losses each year as you go, there's no limits on how much you can invest inside a non-qualified account. Tax deductible. Qualified accounts will have tax deductibility. There are income limits that would impact you depending on the investment vehicle that you're looking at. So for example, Roth IRAs, if I have over a certain amount of income as a married couple filing jointly, I'm not going to be able to make a Roth contribution. Or if I earn over a certain amount on a regular traditional IRA, I'm not going to be able to deduct those contributions from my income. That does not apply, though, for example, to a 401k plan. As long as you're under the contribution limits for 401k plan, if you're making those on a pre-tax basis, those contributions would be considered tax deductible. Non-qualified does not, there's no tax deductibility. So anything I'm investing in a non-qualified account still counts as income to me if that's how it was received. Tax penalties. Because I have all of these benefits on a qualified account, like tax deferred growth and contribution limits, if I take the money out early, it's generally going to result in a penalty tax if I'm under the age of 59 and a half, unless there's some kind of an exception that's available for me. So there usually are tax penalties that we need to at least be mindful of with a qualified account. Versus in a non-qualified account, there don't tend to be tax penalties. We will need to recognize gains and losses. Again, you'll still have taxes that might be paid on the gains and losses that you received in a non-qualified account, but you wouldn't necessarily have a tax penalty associated with taking a distribution from a non-qualified account. Common tax forms. So these are things that you would get like once a year. If you make a distribution from a qualified account, if you take a distribution, you'll get something called a 1099-R. You'll get that at distribution. Interestingly, even if I do like a rollover from one qualified to account to another qualified account, which wouldn't result in any taxation, I'll still get a 1099-R that will show me that I had a non-taxable event, but you'll still have a 1099-R at any distribution. In a non-qualified account, what you're going to generally see are things like a 1099 DIV or DIV or a 1099 INC or income that we would get annually that shows any dividends or incomes that we receive from the non-qualified investments. Those are actually filed with your taxes as part of the income portion of your tax return. Common examples of qualified accounts versus non-qualified accounts. Common example of a qualified account would be things like a 401k, a 403b, a Roth IRA or individual retirement account, traditional individual retirement account, or qualified annuity. Those would be things where I experience some tax deferred growth. I'm going to have contribution limits. They may be tax deductible for me. If I take them out early, I'm going to see a tax penalty, and I'd get that 1099-R at any form of distribution. Non-qualified accounts will be things like a savings account or an after-tax investment. Sometimes we'll talk about those in brokerage accounts. Brokerage accounts are generally considered after-tax investments. Now, there are sometimes where you'll hear people talk about they have an IRA inside a brokerage account. It kind of depends on what your structure is, but what you're really looking at when you evaluate the tax structure is essentially how are taxes paid, when are taxes paid, are there any limits or any deferrals, things you need to be aware of. That's going to dictate which kind of investment you have here. I think it's really important to start here because I can't tell you the number of times I've had people say, well, my investment, my 401k, it has great returns. Well, the 401k itself doesn't have returns, right? It's the investment under the hood that we've chosen for that account based on our goal that has returns. So when I talk about the style of investment, or the style of the investment product, what I'm really asking you about is its tax treatment. Is it a qualified account or is it a non-qualified account? Once we know that, then we can dive deeper into the kind of investments that might be suitable for us inside those investments. What might make sense as we get into this and just thinking through, for example, we were talked about in our last presentation, we talked about long-term, short-term, or intermediate term goals. Let's say I have a short-term goal. I want to set aside $30,000 for the purchase of my primary home. Well, a non-qualified account may be a place to at least consider part of that investment being invested in. So that doesn't necessarily mean that it's higher risk or lower risk, right? Because we're going to have to choose the investment to go into that product. But why a non-qualified might be more advantageous is because I can take that money out without penalty. So those are the kinds of things that you want to consider as you're looking at the investment structure. Is it going to be a qualified account or a non-qualified account? And lining that up with your goal and your time frame. It's going to be super important to make sure you have those lined up together in a way that makes sense. So now that we've got that, what can I invest in? Right? So we spent a lot of time talking about the qualified accounts versus non-qualified accounts. Once we pick those, well, then what am I going to invest in? So we're going to start with the basics here today. We're going to talk about stocks, bonds, mutual funds, and ETFs, or exchange traded funds. Know that there are absolutely more investment options or styles of investments that we can choose from. These are the ones that you're going to see probably the most common. So these are ones that we'll spend the most time talking about. But if you have other situations, we can take a look at those. I just want to make sure that we're upfront when we tell you. Of course, there's more kinds of investments under that you could be looking at. First and foremost, we're going to take this from kind of a high level. The first kind of investment that you could be looking to put either your qualified or non-qualified account into would be something like a cash instrument or cash equivalency. So those would be things like certificates of deposits or CDs, treasury bills, high yield savings accounts, money markets. These generally have the lowest risk and return potential. When we think about an investment option that's in this kind of structure, what we're usually looking for is something that has a short-term goal. Maybe it's something that we want to have a little bit more return than just my regular savings account. Maybe this might be a place for me to, let's say my emergency fund. My emergency fund, high yield savings account, might be a good place for my emergency fund. That might be the right kind of investment vehicle for me. That's probably going to be a non-qualified account, right? Because I need to be able to access it without penalty. And the investment option I might choose for that goal is probably one that has lower risk. So if I have a lower risk or return potential, something a little bit more conservative, a cash instrument and equivalency would be what I'd be looking for. To go up a layer in risk, we're going to talk a little bit about bonds. So as a general rule of thumb, when we think about bonds, I like to say in a bond, you loan, not own, because what you're doing with a bond is essentially you're giving your money to a different organization, municipality, company, sometimes there's other examples you'll see of this as well, where they're going to be using the money that you give them to finance a project, and they're going to pay you back with interest. And that's really what the bond is. They're going to have what we call a coupon. The coupon is what is equivalent to the annual interest that you're going to receive. They also have a par value, which is the face amount of the bond that you bought, and a maturity date, which is the date that you're going to be fully repaid. So when we think about these as an example, when you see a bond listed, it's usually going to tell you within the bond what its annual interest rate is, what your par value is. So if I'm buying, $1,000 is my par value. And then it will tell me the year or the month and year that it will mature. You can buy these at a premium or at a discount. So premium means that I'm going to be paying more money for the bond than its dollar value. So for example, let's look at some examples down below because I think it's easier to see when you actually see how a bond is listed out. Let's look at the top one, the U.S. Treasury note coupon, 4.125%. So that means that's the annual rate of interest it's going to pay. It'll pay that semi-annually. Its maturity date is October 31st, 2026, and it's trading at $102.53. That would mean for me to get $100 on the maturity date, so my par value, $100 on the maturity date, 10/31/2026, it will cost me $102.53 to buy $100 in the future. So the reason that you might buy something at a premium is because the interest rate is higher than what might be available elsewhere. So if I buy a bond that's at a discount, what that would mean, let's look at one that's down a little. Let's see, the Republic of Zamunda as my example. These are all, by the way, all fictional examples. These are not real bonds. If we look at this one, it tells you what its coupon rate is. It tells you when it's going to mature. And then you're going to see that it's trading at $76.58. So for $100 in the future, I'm going to pay $76.58 today. That would be an example of a discount. When you think about these premiums or discounts, this actually ties to that fourth bullet. The primary risks to holding a bond are the interest rate sensitivity and credit quality. When we think about bonds, that interest rate sensitivity, as interest rates move up or down, they're going to have a inverse relationship to what the bond's value is going to be. So if interest rates go up, then if I had a bond right now that was at 4.125% and interest rates went up, that will mean that the price of my bond, my current price of my bond, is going to fall because I'd be able to go buy a new one at a better rate. Conversely, if we see interest rates fall, then all of a sudden the bond that I had at 4.125% looks like a better deal. So usually what we'll see is that in things like treasury notes, in falling interest rate environments, they'll tend to trade at a little bit of a premium, and in rising, they'll tend to trade at a little bit of a discount. When you think of the other thing you'll think about there is the credit quality. I've shown you to the side here what we call a credit rating scale. Every bond is going to get a credit rating, and it'll tell us how likely the credit institute is. There's three that we look at generally: Moody's, S&P, and Fitch. These are the ones that we tend to see, let's say Moody's or S&P probably the most often. What these will tell us is how likely that creditor is, how likely that creditor thinks the bond is to pay on time. Do they think it's going to meet its interest requirements? Do they think they're going to pay us back? Do they think that they're going to pay us back in time? Generally speaking, the longer the maturity is, the bigger risk it is. So if I have to wait 10 years to have that bond pay out, it's going to be a little bit more risk than a bond that has 1 year to pay out. If I have maybe an issuer, the bond issuer has got some adverse situations going on, where the credit rating institute thinks, oh, maybe this one might be a little bit more, a little bit higher risk, then what we'll probably see is that bond will tend to trade at a little bit of a discount, or they'll have to provide a much bigger coupon for us in order for us to consider investing in it. So let's look at some examples again of that you see listed below. The U.S. Treasury notes, when we think about the U.S. Treasury note, this is essentially dollars you're investing in. These are one of the highest rated that you're going to see. It's very high credit quality, very low credit risk. That usually means very low risk, very low return. In that example, you're going to see it's trading at that premium. And that AA that you see behind it is telling us what its credit rating is. It's a high credit rating, maybe not super concerning. Let's look at the next one down. The big time financial coupon is 6%. It's due February 15th, 2026. So this is a really short maturity, right? It's going to mature here in just a couple of months. So as a result of that, it's probably going to have it's probably trading at real close to its par value, because you might only get one interest payment off of that. Its credit rating is a BBB, so it's considered good credit quality, moderate credit risk. So generally speaking, like I was saying earlier, if I have higher credit risk, I'm going to have to give you a bigger coupon for you to consider investing in me. The one below that, the Republic of Zamunda, 4.875 is our coupon rate, but it's trading at a huge discount. But I see if I look at the credit rating, it's a BA. So the issuer is facing some adverse conditions, uncertainty, and substantial credit risk. And it's not going to pay it's not going to mature until 2043. So if the bond is around for that much longer, this might be a really good deal, but there's some considerable credit risk that I'm taking. This is why we say not all bonds are created equal. Bonds tend to be lower risk than stocks, but they do carry risk. So it's important that you understand, if you're looking at investing into something like a bond, that you know what kind of risk you're carrying. Is it a credit risk? Is it an interest rate risk? Is it something that's going to mature over a short period of time or a long period of time? All of these will weigh into how much risk the bond could carry for you. Now, the one other here that I want to point out, it's the very last example, the City in Iowa bonds coupon at 5%, and it's got the fictional maturity date of June 1st, 2026, trading at just a slight premium there. One of the reasons people sometimes look at municipalities or cities is because if I invest in one of these inside a non-qualified investment option, I don't have to pay any federal taxes on the interest that I receive from that bond. So sometimes when people are looking at investing in a non-qualified account, but they still want to have some kind of tax benefit for them, they'll look at municipalities as places to invest to get a little bit of that tax protection. You're usually going to give up some of the yield or some of the return potential, because you're essentially saying I'm going to take less return, less of a yield off of that, so that I can get out of the federal tax component of it. That kind of covers at a high level what you're investing in when you invest in bonds. Now let's talk about stocks. So when we invest in a stock is a partial ownership in a company. They're going to be bought and sold on exchanges or privately. They can be privately held, and they're going to be traded in shares. So when we think about, like, for example, let's use, we've got some examples down below. These again are all fictional examples. We're going to look at the first one. It says big, a large company stock in the tech sector sold on this NASDAQ exchange. What this is telling you is that you are, with every share that you buy of this fictional big company, you are buying a sliver of ownership in that company. You have a say in that company. With those, there's some things that you want to know. When we say that they're bought and sold on exchanges, or they're privately held and traded in shares, what they're talking about there is what's the market that I'm going to buy or sell a stock on. I think a lot of times when we think about at a high level, sometimes people think about like the Dow or the S&P. Those are actually not exchanges, right? Those are indexes that we use to measure the overall market. We tend to think of things like the New York Stock Exchange or the NASDAQ. If we're buying from an international or buying an international stock, we might even be buying that on an over-the-counter market. When we think about, so what we're thinking about with respect to those exchanges is where we could go buy that stock, where it's actually being bought. Sometimes you'll also run into privately held companies as well. This is sometimes you'll see this is pretty common in like partnerships, S Corps, those kinds of things. You can also see these sometimes in, there's some organizations where they'll have company stock. That company stock may have these privately held stock shares that they're going to issue usually once a year, maybe at a specific time throughout the year that they'll be issued. They'll sometimes give you an opportunity to sell your shares back, but they're generally not something that you're going to be buying and selling in a more traditional investment sense. The price changes intraday for publicly traded stocks. So if I'm bought and sold on an exchange like the NASDAQ and the New York Stock Exchange, the price of my stock is going to change throughout the whole day. The return that we get from a stock is generated from the change in share price and the dividends that are issued. Generally speaking, stocks have higher return potential and higher risk potential. Our publicly traded stocks have ticker symbols that you can track and research. We'll talk about that here in a second with our examples. But what's really important to understand is that stocks can have wildly different risks based on the company, the sector, the management of the organization, the country that it's in. You can actually have stocks that are less risky than bonds, just depending on the kind of company that you're looking at. So one of the things, again, going back to the last slide where we talked about, just because you're investing in a bond, it doesn't necessarily mean that it's a low risk investment. Just because you're investing in a stock doesn't necessarily mean it's a higher risk investment either. Let's look at some examples of this and we'll talk through it. So BIG, this is again, fictional company. We're saying big is the ticker. Generally speaking, when you're looking at a stock, it's going to have a 3 to 4 letter name, and it's going to be things like they try to do things that are help you kind of identify what kind of investment it is. You can see ones that are even 1 or 2 letters. Those you can look up. You could pull them up on your phone. You can go out to Yahoo Finance. There's all kinds of different places you can go in. You can enter in the ticker symbol of that, and you can see what exchange it's going to be sold on. You can see information about the company, its profit loss margin, anything about it, because these are going to be publicly traded companies. So they have to provide information about themselves publicly for you to research. So again, going back to these examples, if I have big, it's a large company stock. It's in the tech sector. It's going to be sold in the NASDAQ exchange. It may be higher risk in the category, but it might be a lower risk than maybe a small company or a mid-sized company. I used to give this example a lot of trying to explain the differences between a very high risk stock and a lower risk stock of, you think about a company like Nike, for example, selling shoes. They're international at this point. They've got shoes and clothes and all kinds of different resources. They've got apps. They're pretty diverse as an organization. If I compare them to, say, Crocs, you can see immediately how Crocs is going to be a much less diversified company and might be a much higher risk investment than something like Nike. Doesn't mean that Nike's not higher, doesn't have risk or return potential. Just at a relative basis, you can kind of begin to maybe think through how those would compare. Similarly, in the second example, we have BY, again, fake company. This is a large company stock in the consumer discretionary sector. It's going to be sold on the New York Stock Exchange. It's probably going to be lower risk than a small or mid-sized company in or certain sectors like the tech sector. The consumer discretionary might be lower risk. INT, we're going to say that this is a fictional example of an international large company. It's in Japan, sold on the OTC market in the US dollar. This is probably going to be a pretty high risk investment because now not only am I dealing with a stock company, I'm dealing with a company that has international risk and also is going to be subject to, what's happening to the US dollar. If the US dollar is going down in value, it's going to make it a little bit harder for me to buy that. So there's multiple risks that you could be looking at with respect to an international options. International options tend to be higher risk stocks. Bob's company is my last example. So this is a company with privately held stock, not traded publicly. They probably will have something called an annual NAV, which stands for net asset value. That's the price of the stock. They'll usually only set it once a year, and they'll buy back company stock or shareholders, and the risk is going to be dependent on the company that you're choosing. So now that we've kind of set the stage for cash, bonds, and stocks, how do we pick investments that will work on that? Well, sometimes what people will do is they'll look for mutual funds and ETFs. Mutual funds and ETFs are similar in that they may hold multiple stocks, multiple bonds, commodities, cash, and they can blend them together or invest them in maybe a specific niche, depending on what the objective of the funds managers are. Now, mutual funds and exchange traded funds are not identical, but they're fairly similar in how they operate. So mutual funds are going to trade once per day. It's going to the share price will be set every day at 4 p.m. Central on the market open on the days the market's open, where ETFs are going to trade intraday. So they trade a little bit more like stock in that way. Mutual funds and ETFs can be lower risk than owning a single stock or a single bond, because a mutual fund and ETF, as I said earlier, they can own hundreds of stocks. So now instead of taking on the risk of just one company, I'm spreading the risk across hundreds of different companies. Both mutual funds and ETFs will have a ticker. Mutual funds will trade in partial units or shares, where ETFs will only trade in whole shares. So ETFs, again, like stock is going to do the same thing. They're only going to trade in a whole share. I can't buy partial shares of stocks. I can't buy partial shares of an ETF. I've got to buy whole shares. But with mutual funds, I can say, give me $100 and however many shares of that I buy is however many I buy. Mutual funds and ETFs will both have annual expenses for the management of the investment, and it's going to be expressed in something called a basis point. It's going to be a percent on an annualized basis that you're going to pay for the management of that option, right? Because that company is going out and they're choosing the stocks or bonds to buy based on their risks. You're paying them for that professional service. So if I'm looking for, I want something that's going to be a little bit easier for me to operate. I don't want to have to go out and do research on what stock to buy, what bond to buy. I just want to pick something that kind of aligns with my overall investment objective. I can buy a mutual fund or an ETF, and I'm essentially going to be paying on an annual basis for that manager's performance or that manager's skill. Those will always be published. You can always find out what the cost of that is. Mutual funds and ETFs will both have what they call a prospectus that will tell you about the management team, the strategy, objectives, operating costs, etc. If you want to get in deep and learn more about what that manager is doing, the prospectus is where you'd go to find that information. So let's look at a couple examples. So again, all of these are made up. Mutual funds are always going to end in an X, and they're always going to have 5 letters. So if I see something like the top one that says IINTX, I know immediately that that's going to be a mutual fund because it's 5 letters and it ends in an X. This is an example of an international fund. The option is what they're going to call actively managed, which means it's the investment manager is going and actively choosing, actively picking what stock to buy. It's going to own, in this example, 150 international companies across a number of different countries and sectors. The risk in this kind of investment option is likely a little higher, right? Because I'm going to be investing internationally. And even though I've got a little bit more diversification than I would if I just bought a single international stock, in this example, I'm still investing in international. So it's probably going to be higher risk. The second one we see is BALAX. Again, I can tell just by looking at it in this example that it would be a mutual fund because it's 5 letters, ends in an X. This is an example balanced fund. In this example, we're going to have something that owns 50 US stocks, 20 international stocks, and 12 bonds. So you can see how in this kind of an investment, just because I'm investing in mutual funds doesn't mean that I'm high risk necessarily, and doesn't mean that I'm investing in all of one kind of thing. I've got different kinds of investments within this. This is also going to hold some cash. Maybe it has some precious metal holdings as well. The risk on this is likely lower because it's blending stocks and bonds across a wide range of sectors and styles. So I could expect that if I had an investment like this, it would probably have, generally speaking, less risk associated with it than the last example we looked at. Let's look at the third example there, bond. This is an example bond ETF. In this example, we're going to be looking at something that owns corporate and governmental bonds with an average duration, so the maturity, when that bond matures, of 5 years. This should be a pretty low risk investment option. But if interest rates were to increase or increase dramatically, you could experience negative returns in this kind of an example as well. The last one, COM, this is an example of a commodities ETF, which trades oil and gas futures. Well, because it's trading oil and gas futures, I could expect this one might be very risky. This fund could be much more risky than the international option that we looked at first. So again, just like we've talked about with bonds and stocks, mutual funds does not necessarily mean that because you're investing in a mutual fund or an ETF, that you're investing in something that's lower risk or higher risk. You need to understand what is this investment option investing in so you know what the relative risk associated with it is. So other considerations for you, is there more to it? Of course. There are all kinds of investments and other options for trading. Once you kind of understand the basic of the investment vehicles, though, that's going to be the building blocks to help you understand what you're really looking for, because you really need to understand before you jump into investing. You really want to understand what risk is appropriate for you, your situation, the goal, the objective that we set, the time horizon, your overall comfort level with that investment option before you invest in it. If there's any kind of a golden rule for investing, it's going to be never invest in something if you don't understand the risk associated. Make sure that you understand, am I investing in stocks or bonds? What kind of stocks? What kind of bonds? What's the objective to this? If you've got questions about those things, make sure that you're reaching out, you're asking people so that you're investing in something that really does fit with your overall objectives, especially as we get into then assigning an investment option for our goal or objective. So now that we've talked through those basics of, are we investing in something that's qualified or non-qualified? We've talked about kind of investment basics, cash, stocks, bonds, mutual funds, ETFs. Now we need to talk about addressing risks. How do I know what kind of risk is appropriate for me? Well, there's a few things that I want you to keep in mind first as we get into that. First thing is to know that stocks do tend to rise over the long term. What we know is that if I can invest in the S&P 500, S&P 500 is just an index that's used by the industry to measure the largest 500 companies in the United States. So that's why they call it the 500 S&P 500, 500 stocks in it. You can get mutual funds or ETFs that try to mirror the S&P 500. It's important to note they are not actually investing in the S&P 500. They're investing in something that is intending to mirror that. We call those passively managed options. If I was to invest in one of those options for 1 year, there is about a 74% chance that I would have an increase, or my stock would rise over that period of time. If I can do it for 3 years, it's about an 85% chance. If I can invest for 10 years, 92% chance. 15 years, 100% chance. So when I'm thinking about stocks in general, stocks do tend to rise over the long term. That's why it's so important for me to know what the time horizon is of my goal. If my goal is I want to have $30,000 for myself in 5 years, I might not want all stocks because there is still a pretty good chance that I could lose over that period of time, right? So keep in mind, stock market will jump up and down. It will be variable. You're going to see markets go up and down crazy. Your job as an investor is to try to manage your own temperature as you go through that and invest in things that kind of align with your time horizon. So you're not putting yourself in the position of having to push back your goals because of your investment returns. With that, when we talk about managing risk, one of the things I think is really important to understand is we can't control the market. You can only control your behavior to it. You want to make sure that you're well diversified. You want to make sure that you're dollar cost averaging, which just means I'm contributing regularly no matter what's happening in the market. And then I rebalance. I keep myself in line with my overall risk objective. What this is showing you is the investment return for an S&P 500. If I had invested that from 1990 through 2024, and I had left that invested the whole period of time, fully invested, I would have made about 9.8% return over that market period. If I pulled my money out though, and I missed just the best 2 days over that period of time, I've now cut my return down to 3%. If I missed the best 20 days in that period of time, I will have been negative 24%. This is why I say to people, when you're thinking about risk, what's important is that you have a good asset allocation that you can live with, and that you remember these are long-term investments. If you are looking at something that is a short-term investment, you need to also make sure that that is lining up, that you're investing in a way that's appropriate with a short-term risk. So let's talk about the power of asset allocation. 91%, 91.5% of performance is going to be determined by your asset allocation. And allocation is going to include a mix of investments like cash, stocks, bonds, just like we've talked about. So I'm giving you a couple different examples here. You might have an example where 70% of it is going to be in bonds and cash, and 30% of it is going to be in stocks. That's a pretty conservative investment. That might be appropriate for a person who's got a pretty short time horizon, maybe 5 years. If I've got a longer time horizon and I want to see more potential growth, I might look for something more aggressive. So maybe it's going to have the opposite of that, 70% stocks and maybe only 30% bonds. When we think about our asset allocation, it's just really an approach to manage our investment risk by diversifying among our asset classes. Over any period of time, one asset class may be increasing in value while another is falling. So having an asset allocation and diversification does help us manage our investment risk. So this goes back to when I'm selecting an investment for the product that I'm going to be using for my goal. It is probably important if my goal is, let's say, a long-term goal and I want to have money to retire on. I probably don't want to put all of that into a single stock. I want to make sure I'm diversified, that I have money across different things. But if my goal is, in 2 years, I want to have money for a vacation, I could put the whole thing in cash, right? I could be very conservative and it doesn't necessarily need to be super diversified, because my risk on that is going to be very, very low. I'm taking very little risk. I'm putting most of it into cash instruments. The other thing I'd mentioned earlier is making sure that we rebalance. So what that means is that, especially if I have a longer term investment, like something that's say 10, 15, 20 years out, something like our retirement accounts, we want to make sure that we're evaluating that and rebalancing that over time, because what tends to happen, stocks tend to outperform bonds over time. So we might have a starting allocation that we feel really comfortable with. Maybe it's something like this example, 40% in stocks, 50% in bonds. I got 10% in cash. It's a pretty, moderately conservative investment. But 1 year later, my stocks have outperformed my bonds. Now I'm at 49% stocks, 42% bonds, and a little bit less in cash. Well, if I didn't rebalance, what's happening is that my portfolio is actually becoming more aggressive over time. So rebalancing it helps us keep our allocation as it was intended, closer to our overall goals, and keeps us maybe more in line with what our risk objectives are. All right, so now that we've gotten through talking about qualified versus non-qualified, the kinds of investments, how we assess risk, let's talk about investment vehicle basics. Again, common investment vehicles, we'd see individual retirement accounts, IRAs, qualified accounts, after-tax brokerage accounts, non-qualified, 401k, 403b, 457, a simple or a SEP, those are going to be qualified accounts. A 529 plan or a KEO plan, those are going to be generally things that we see for college savings. Annuities can be either qualified or non-qualified. And CDs, these are common investment vehicles that we see people use for their goals. A lot of times I will have people say, well, my 401k performance is really good. And again, it doesn't have anything to do with the vehicle itself. It's the investment option that you've chosen under the hood of that. So we want to select the right vehicle for our goal and then the right investment for that vehicle. So let's talk about the right vehicle for the goal. You want to start by asking yourself some important questions. What's my goal? What's my time frame? How much risk am I comfortable with? What are the tax consequences of the investment or the investment vehicle that I'm choosing? Those are going to be good frameworks for you to take your financial planning goals and then to apply the right vehicle to that. Let's walk through some examples, because I tend to be the kind of person who just sees examples as easier ways to kind of talk through it. All right. So let's say my goal is an emergency fund. Okay, well, my emergency fund is probably going to need to be a non-qualified account so that I can get that money out without penalty. Probably going to be something like a high yield savings account or a money market, something that is not going to have penalties for me to withdraw that early if I need to. So for example, a CD is probably not a good option for an emergency fund, because if I have to pull that money out early, I'm going to forfeit any of the interest I earned on that. So that's an example of our goal. Our goals are our emergency fund, our investment vehicle. We're looking at something non-qualified and something that has low overall risk. So a high yield savings account or money market, one of those cash style investments. The underlying investment product that we have in a money market, it's going to be these 90-day treasury bills. You're not picking them. The money market itself is picking them. When they say 90 days, that's talking about the maturity, right? So these are things that are maturing very quickly. They're very low risk, very low return potential, but they're a place where we'd be able to put our money, get a little bit of interest without a whole lot of risk. Now let's say my goal is I want to save for college. That's high on my financial planning list. I want to make sure I'm saving for college for my kiddos. Well, I might look at something like a 529 plan or a KEO. Inside a 529 plan, I can look at different mutual fund options. Almost every state, by the way, has a 529 plan you can go take a look at, see what their investment options are, and it'll tell you, they'll give you different options within that to invest in. They'll generally be mutual funds, and you can look at the kind of allocation you want based on the time horizon. So let's say your kiddo is going to be heading off to college. They're 8 years old now, so you have 10 years. Well, you might want something with a more balanced allocation. But let's say you have a 1-year-old. They've got 17 years. I've got a pretty long time horizon. I could also choose something that's going to have a more aggressive allocation. So I want to choose that risk in line with my time frame. The shorter that I have to fund that goal, probably the less risk I'm going to want to take with it. Saving for retirement, generally with those, right, we're going to see a 401k plan or a 403b plan, an IRA or a Roth IRA, something along those lines. Mutual funds, ETFs, stocks, bonds, all going to be pretty appropriate for those kinds of investments. Again, looking at our time horizon. If I have 20, 25 years to go, I'm probably going to have mutual funds that have a gear or objective toward uh, stocks. I'm going to have more stocks in there, a long-term objective toward growth. If I've only got 2 years to go to retirement, I'm probably going to be looking at mutual funds that own a lot of bonds or own more bonds, maybe things that are more balanced. I don't necessarily want the same kind of risk associated with my retirement plan when I'm closer to retirement. If I'm saving for a first home, again, I'm going to be looking at a non-qualified account here in most cases. You could look at a Roth IRA. I'll talk about that in a second. But in these, again, looking at the time horizon, it could be a mutual fund, a CD, ETFs, T-bills. If I've got a short period of time, I might look at something like a CD that kind of lines up, the maturity kind of lines up with when I want to purchase that home. I had mentioned Roth IRA because there is an option within Roth IRAs. If you've opened up a Roth IRA, there's an exemption that will allow you to take up to $10,000 out of your Roth IRA for the purchase of your very first home. Be aware, if you already bought a home and you're looking at your second home, a Roth IRA does not work, but for a first home, that might be an option for you that allows you to get some of the benefits of those Roth accounts. It is a qualified account, so you get the tax deferral on growth, but you can pull it out early without penalty as long as it's for the purchase of your very first home. You're looking for income in retirement. If that's your goal, you might be looking at something like an annuity, an IRA, 401k plan, again, kind of lining up with how much risk you want to take. A lot of times when we start talking about income in retirement, that's where people might need a little bit more support in choosing the investment products that are appropriate for them and helping them really plan out how they're going to do that income. Lastly, home repairs. A home repair, I'd probably want a non-qualified account for this. It'd be something like an after-tax account or a high-yield savings account. This would be something where you might look at, a CD or bond or T-bills, T-notes, something like that if you have a time frame that you're looking at. Hopefully, this gives you a good sense of the kinds of investment vehicles that you might be looking at. I know that there is a lot more to it than what we went through today, but I'm hoping that this at least begins to open your eyes to, once you've kind of set a goal for yourself and you've set an objective, how do we then begin to think about investing for that? As always, if you have questions, I'm more than happy to help you talk through any of the situations that you might be thinking about, and we can come up with some different considerations for you. Next month, we will be talking about how we protect our plan. So part 3 of our financial planning is going to be in December. We'll be talking about setting up estate plans, wills, things to protect those goals that we've set for ourselves. I really appreciate you joining. I hope this has been useful for you. Have a wonderful day.